Hello everyone, welcome to another video. In this video, I would be explaining you in very simple terms what equity is. So the channel name Equity Essentials. Gets really important to know what equity really stands for and what it means. So it's a very simple way I would try to explain you. Equity means basically ownership of a company. So you own a part of a company in bits and pieces. It might be the entire company, it might be a certain percentage of the company. It's basically a ownership in the company. So suppose let's try to understand this with an example that is you and your friend start a business and your friend invests 6 lakhs and you invest 4 lakh. So your ownership is 40% and your friend's ownership is 60%. So that's how in simple way you can understand what equity is basically a ownership in terms of number of shares or the total percentage which you own in the company. So founders own equity, investors buy equity, and employees get equity into the form of ESOPs. So founders generally are the one who start the company, have the majority of the company with them, and they slowly start to sell their company. That is, sell the stakes of the company in uh, in order to expand the company. Equity versus salary. So equity is a very different thing than what salary is. Equity means ownership, and salary is the income an employee gets in exchange for the efforts, time, energy, and value he or she brings to the company. Profit earned is the profit the company makes in a certain period of time. That's profits, and that's not equity. So it's are very different. These three terms are very different. So equity in the stock markets is basically exchanging or trading equity. That's person A is selling or buying shares to person B. So that's how a transaction is made in the stock market when a person who feels the company is not doing good or might not do good sells his or her equity to a person who has a different opinion on the same stock. I would slowly explain you. So why equity is powerful? Equity is powerful in the long-term wealth generation process. So once you have a good chunk of equity in your hand, and as the company performs good, makes good profits, the investors in return have the equity appreciate in terms of its value. So the company's share price grows. So the common misunderstandings regarding equity, that's equity is instant money. That's totally wrong. Equity is again a long-term game, and you need to have patience in order to get good returns from holding equity in a certain given point of time. That's 5 to 10 years in the long run, or maybe 2 years, but you need to have patience in order to make money from holding equity. We are on the Screener website and looking at the Kotak Mahindra Bank financial statements. Let me head over to the investors and the shareholding pattern. So these are basically the four type of people who might hold their stake in the company. The number one is promoters. Number two is FIIs, that's financial institutional investors. The DIIs, that's the domestic institutional investors, and the last one is public. I would get into details what these terms actually mean. That's DIIs and FIIs. So let's head to promoters. So Kotak Mahindra Bank promoter is basically the one who founded the company, then followed by other investors here. So the majority share in Kotak Mahindra Bank, that's 25%, is still held by the promoter, the founder, Uday Suresh Kotak. And then comes FIIs. You can see the entire list of FIIs, how much FIIs actually hold in this company. That's 29%. Then comes DIIs. They hold 32% of it. And then it's the rest of the public. That's 11% of the shares are holded by the company. So it's basically bits and pieces of the company held by different people. It might be the promoters, might be the institutions, or it might be common people like us or the smart money. So the key takeaway here is equity is basically ownership in a business. Might be few shares, might be very huge amount of shares, or might be the entire company. In cases of private limited company, there are limited shareholders holding a good chunk of stake or equity in that company before they go public. Thank you so much for watching the video. Signing off.